All right, so there's no reason to hold up progress here. Let me see if I can get my stuff right. Yeah, ain't that the pits? Did that move it? Y'all see y'all see cows now? All right. So there's my first graph. I just want to make sure. Becky, you see that, don't you? Okay, good deal. You know, the agents that are on saw a lot of this last week, but for the producers, you know, we've been watching these prices slide in a hurry, and we finally had a turnaround in slaughter cattle prices, and that helped feeder cattle prices a little bit. I want to just briefly talk about prices on these animals where we've been, but the last three slides is really what I want to focus on as we look for management decisions. But we've watched these prices slide from $140 back in the spring, and now we're sitting around the 104, 105 area, and the market has not been very kind this week. We'll actually be able to know today when the Fed Cattle Exchange, when they sell today, there'll be a lot of cash trade, and we'll see if the market has a firmer tone or a lower tone on the finished market. I'm expecting it to be even. I'm really not expecting it to go up or down, because yesterday the market actually stabilized some after dropping earlier in the week as far as the futures market's concerned. From the standpoint of calves and feeder cattle, anybody that's selling calves right now are probably losing dollars. They're losing money. They probably spent more on producing this calf than what they're getting paid for. And the even sadder part about that is those guys that are in the stocker business, if y'all have stocker producers or if you are a stocker producer, they bought a bunch of animals at a really, really high price, and any of those that they're trying to sell right now, the price that I'm showing represents just a weekly auction market price, and a load lot price would very much benefit and look a whole lot better. But most of those guys are still losing money just because of the cattle price decline since back in the summer. And any of those animals are trying to move on out. Slaughter cows, for those of y'all that are in the cow business, and for those that are in the stocker business, because we need to start looking at how we market these slaughter cows. But if you're a stocker producer, you also may want to look at the opportunity of buying these thin cows during the fall months if you've got grass, which that's the problem right now. We're in terrible drought situation, and part of the problem is you know, things look as if it would benefit our producers to precondition their calves or background those calves through the winter into the first part of the year. The problem in doing that is we don't have grass in a large portion of the state. We're struggling with these drought issues, and so it's going to be more expensive to put weight on those animals and carry those animals. Similarly, these slaughter cows, a lot of people are just having to get rid of them and probably getting rid of more cows than what they really want to because of the drought situation that we're in. But we're suffering huge losses and from selling those animals. When you lose $20 to $25 a hundredweight on those animals, and you're looking at $300 or $400 a head for a 1,200-pound cow that you've lost value in the past 2 months, that's a really big hit for those animals. A thing to note is that heifer slaughter has picked up tremendously the past 5 months. Year to date, we're up 2.4%, but we've had several weeks where we've been up 10 to 15% on heifer slaughter compared to a year ago. Make note that even though this means that we're not retaining as many heifers, it doesn't mean that we're not still expanding the cattle herd, because the rates at which we're slaughtering heifers right now does not mean that we're not still expanding this cattle herd. It means we're slowing it down tremendously. That's a key factor that we're looking at right now, is that we've slowed down herd expansion, and it's still growing. But for those producers out there that are thinking about developing heifers to breed and sell next year, you know, we've had several recent sales. I need to find out what the Washington County heifer sale results were, and actually Jacob Boone may know, because it being up in his area. I don't know if anybody else is on that's in that area, but I need to call Anthony probably and find out what that Washington County sale deal. But we had several bred heifers sell in the $1,400 to $1,500 range a couple or 3 weeks ago, and $1,500 is about the max that anybody's getting. And so people that are buying heifers now to breed and market next year need to really consider that may not be the most profitable thing. But on the flip side, people that are purchasing heifers, next year may be a great time to purchase bred heifers because we're probably heading towards the bottom of the market in 2017 or 2018, which then in turn means that the market will go back up, and those heifers will increase in value as we move on, and those calves that they have will increase in value looking into 2019 and 2020. I know that seems like a long way away, but I thought when I started this job 4 years ago, 2016 was a long way away, and it jumps on us in a hurry. Steer slaughter is up 6.7% year over year. So we've got animals out there. This means huge beef production. Additionally, beef cow slaughter has picked up tremendously. All right. So still, doesn't mean that we're contracting the herd. It just means that the rate of expansion has slowed tremendously because these levels are not going to reduce the cattle herd. They're just going to slow the expansion mode. So 2007, when we get to January 1, we're going to see where 2016 had a pretty large increase in cattle inventory. We'll see how that turns out January 1, 2018. But with this increased slaughter is increased beef production. And this is where the rubber hits the road, because we've increased beef production, we've increased pork production, and we've increased broiler production. And when we really get down to this and we're looking at all the meats being produced, what are we going to do with all this meat? I mean, we're talking about large quantities of meat and really not always having a place to go with it. And the consumer's still not happy about the beef price at the retail sector. And so it's going to take some lower prices at the retail level before we actually see things pick back up from a cattle producer standpoint. So briefly, the wholesale price of beef has been going down, but packers have been making money left and right because they've been buying these slaughter cattle for a lot lower price. So if we look at that from that standpoint, we've seen a bigger decline in cattle prices than we have in retail beef price. But that retail beef price will continue to ratchet down, especially as pork prices and broiler prices or poultry prices ratchet down. They're just not going to do it as quickly, and it has a lot to do with the production phase that we're in beef production relative to the other quicker meats that turn things around quicker. I know Aaron's already touched on the feed price situation, but I think it's key that we think about what's driving our market. Yes, prices drive, the price of beef drives the market, demand drives the market. But when you look at this drought situation that we're in, this time of year, which is when the majority of our calves are coming to market, the two places they go are either the Southern Plains or they stay at home. All right. And, from personal experience, I know that I planted 47 acres of rye behind soybeans with the intention of purchasing hopefully 60 to 120 head. The hope was 120 head of stocker cattle to put on that rye this winter. Now, given the situation that we're in, the rye is green, but it's not growing. So probably not going to be able to purchase those animals. So therefore, you take a person out of the market, and I'm sure there's several other people that have done the same thing, that they can either play the odds and hope for a rain and they get grass growth, or they're going to sit and wait until they know they have something. similarly, I'm sure we had a bunch of folks that spent money trying to stockpile forages in August and September, but there's some of these areas that have not seen rain during that time period. And so we know they hadn't stockpiled forage, which is where we put a lot of these stocker cattle. Then we move over to the southern plains, and you can see how the drought has crept in to eastern Texas and eastern Oklahoma. Of course, you know, Kansas has a lot of wheat grazing as well, but those folks out there have experienced several years of repeated drought, and they haven't been as quick to pull the trigger on their wheat yet. They got wheat planted at a good time. They actually got some good rains on their wheat back in August and September, but they're not going to pull the trigger on buying the number of head that they normally buy until they have a pretty good solid idea that they're going to have enough forage to fill those animals. So that's the situation that we're looking at due to this drought. We'll see how it continues to play. You know, I can guarantee you there's Alabama and Georgia animals that are moving out because of how dry it is. John Goddard the other day asked the question at in-service training in the Eastern region. You know, he's got a producer that somebody's called about buying their hay, and you know, the question was, should I sell all my hay and just sell my cows too, and then buy back later? You know, I'm not going to sit here and give a blanket statement that says this is what we should do, but you know, for the viability, how much is it going to cost to feed your animals over the winter? There's a lot of people who have been feeding hay since the middle of September or before in some cases. A lot of that had to do with overstocking pastures, but, you know, with the expectation of having a pasture stock based off of a good year, we didn't get the good fall that we normally get. And folks are having to either move animals or purchase something. And I don't know if y'all have noticed, but hay prices are going up. Hay prices are definitely going up. So the hardest hit region of our area is definitely down near the Chattanooga area, and as you go up that I-75 all the way up to Knoxville. Around here, it gets a little hazy because of these wildfires, but or forest fires or whatever you want to call them. So the national average on hay price has not increased. And that's largely due to because the major hay producing states that focus on hay had really good hay production. So it's not that hay's not available. It's just the fact that we can probably buy it for a fairly decent price. I'm talking about good quality hay for a good price, but getting it shipped here is what's gonna be the expense that most people are gonna face. So I think this completely plays into our marketing tactics and schedule as we look down the road. So what's going on in the feedlot? Let's back up real quick. Let's look. That's a good set of Hereford cattle right there. That's just a good set of Hereford cattle. Not that anybody cares about Hereford cattle, but they can grow too. It's cheap to feed cattle in the feedlot. Note that based off of September closeouts in Kansas feedlots, 75 cents on feeding costs per hundredweight. That 75 cents per pound of gain is pretty cheap. And I know the boys in Iowa are doing it a little cheaper than that. There's several of them that their corn price is depressed terribly relative to where they would have wanted it to be. So there's a bunch of those farmer feeders up there that are ready to feed cattle because cattle are cheap right now. Corn's cheap, so they can buy a cheap animal, put cheap feed in them, and hopefully next summer they're going to walk those cattle to market, and they're going to make their corn crop on cattle for 2016. Aaron, I don't know how that fits into everything corn wise, because it's feed is just one part of the corn equation, but that's what we're going to see a lot of those guys end up doing that have the ability to feed cattle. I just want to make note, this is the November feeder cattle futures market. The November, I should make a serious note here, folks, that the contract for starting this November, so the contract that this chart represents, changed in November. So prior to November, it represented a 650 to 849 pound steer. Every contract previous to that, that's what it represented. These contract prices now represent a 700 to 899 pound steer. So essentially, this is an 800 pound steer price.
Andrew, we can't see the chart. If you can just try to share, we're still on the DTN Livestock one.
Have you been on that the whole time?
Yeah, we've been on that one. See if you can switch your screen or your view.
Well, I tell you what, I apologize for that because y'all were supposed to be seeing slides. How does that do?
There you go. That's the chart. Thank you.
Crap. Well, that's terrible. That's just terrible. That's kind of embarrassing now. Can you still see the chart?
Nope.
But you can now.
Yep.
Okay. And did it just change?
Yep.
All right. Well, I'll go back and I'll show you some of the things that I was talking about. We're not going to – this is the heifer slaughter, how it's picked up. This way y'all can see the charts. These I so apologize. I thought these were going and nobody said anything. Thank you, Aaron. But heifer slaughter picked up, steer slaughter's up, and cow slaughter's up. So that resulted in beef production being up, pork production being up, and broiler production being up. I hope that puts together some of those pieces, some of that together. And then all the drought situation revolved around this U.S. drought monitor slide right here. So I hope that still makes sense to those of you that I totally lost there. Ronnie, I don't know if you got lost, but I hope you didn't. That's what I was trying to focus on here. That we've seen prices decline, meat production is up, and now those are all forcing our prices down. And now we're in a situation where drought, being that outside factor that impacted us in 2012, is now impacting the Southeast again. And unfortunately, this drought monitor looks a lot like that we saw in 2007, where the Southeast was just pretty much devastated. And then this is the hay price that I was talking about that goes along with it. So then I mentioned these nice set of Herefords, and y'all are like, well, I don't see any Herefords. So I apologize for that too. Cheap feed. And then we got to what we're looking at on these 8-weight cattle. You know, we the sad part is we educate on price risk management constantly, and as many of y'all know from what I have been teaching in Master Beef the past 2 years up until this fall, I focused some on livestock risk protection insurance, and I also introduced futures and options to folks. And the past 2 years, I don't want to say I've been laughed out of the room, because it's not like people laughed me out of the room, but very few producers took price risk management very seriously because prices were so high. And when you can sell a 550-pound steer for $1,300, $1,200 or $1,300, who's worried about price risk management? Who cares if the price goes down $10 a hundredweight? That's only $50. Well, all of a sudden, it does matter. And you can just look from, this is the November contract, and from August until there in the middle of October, we went from 142 down into the 115 mark. You know, we're still $18 per hundredweight behind where the November contract traded in August. And I do know there were people that forward contracted October and November delivery in August, which was a very smart move. Not a lot of people did it, but those are things we need to be thinking about. How can we contract these cattle? How can we protect the price? Now, the situation is price risk management is actually more important when prices are high than when prices are low. And that was one of my educational points in Master Beef is when prices are high, there's more to lose. You know, when these prices get down to zero, they can't go any lower. So, you know, yes, based off of today's market, do we have downside potential? Sure, we have downside potential. And we probably will see lower prices in 2017 than we experienced in 2016. I'm not talking about picking a point in time. I'm talking about that yearly average price in 2017 will be lower than the 2016 price. But that's because we had really strong prices the first 5 or 6 months of the year. So we need to be thinking about how we, you know, you take this $18 loss on people that are selling animals right now, $1,800 per hundredweight. Well, you know, if we got an eight weight steer at $20, that's $160. So we're just right at $150 a head loss just over time because of that. Similarly, as we look into next year, you know, this is a huge discount. This is August, the August contract, and we're looking at these August markets moving lower. So we need to think about how we've got cattle on the place right now. Whether we got calves that we're weaning today, what are we going to do with them? Or if we've got calves hitting the ground today, what are we going to do with them? Or if we're that stocker producer who's purchasing animals right now, what do the prospects look like? So, what do those prospects look like? Let's take folks that are weaning calves right now, or that could purchase calves right now. 525-pound steer worth about $1.14 last week in Tennessee. If we carry that animal to April to 800 pounds, the futures market is pricing in a 112 based off of our basis and some expectation of what we think prices are going to do between now and then. That gives us a value of gain over the time period of $1.08. That is a very, very good value of gain over the next 5 or 6 months. The problem there again comes in is, where are we going to get the feed? You know, that cost of gain, if we had grass, we can easily do it for 40 to 50 cents on cost of gain. But right now, most of our guys are going to end up having to feed some type of commodity or commercial feed or byproduct of some sort. They're going to have to fulfill that ration. There's just no way we're going to get 2.5 pound of gain, or just 2 pound of gain a day on the grass that we have in most parts of this state. So that's what the November through December, I mean into April outlook is. What if we go ahead and put those animals on feed? Right now, I don't know if anybody's paying attention to the market and how well they're paying attention to the market, but 6-weight cattle are a terrible sale right now. I was in Virginia on Monday night. Virginia sold 44 loads of cattle, and anything from 600 to 900 pounds could be bought for $1.20. All right, and if you go and look at the weekly auction market data, you see, and it's evident that the feedlot doesn't want a 6 to 650 or 6 to 700 pound animal, nor does any of the stocker producers want a 6 to 700 pound animal. So it's actually the sad part is stocker producers probably should be buying those 6 to 7 weights right now, because they are the best purchase that there is. Because if you think about the fact that right now there's no price difference between a 6-weight and an 8-weight, well, it seems pretty good that if I'm selling my 8-weights, and that's not because 8-weight prices are low, that's because 6-weight prices have been terribly discounted. But if we throw these animals on in the feedlot and carry them into June or July, which makes them calf-fed animals, but it is an alternative that we have, and we're going to say that we finish them at 1,300 pounds with a 3.7 pound average daily gain will get us there. That expected value of gain is 85 cents per pound. Does that really look that good? Well, based off that June and July expected finished cattle price of $97 a hundredweight, I don't, do I expect it to be $97 a hundredweight next June or July? I think we're going to be at that dollar level. I think we're going to be teetering on which side of a dollar do we want to be at. And so $97 is very, very possible. We could price a 97. The thing is you could price $97 a hundredweight on those animals right now, and that would give you 85 cents per pound value of gain. And in Kansas, it's costing you 75 cents. So you're making $10 a hundred, which in this case would be, $70 or $80 a head profit. Does $70 or $80 a head profit really warrant the risk? I'm not sure. I think it's something that producers need to be evaluating and thinking about, though. What about the fall-born steers in May? And looking at different situations with those animals. We can sell those fall-born cattle, and you can put heifers in here too. I'm just using steers because of the value difference. We can market them in May at weaning. We can market them in August after a backgrounding, or we can market them in December by putting them in the feedlot. All right, so December a year from now. So what is that looking like? If we just use today and what the futures market is telling us, we can market those animals for $680 in May at weaning, or if we carry them into August as backgrounded, we're going to see a 78 cents value of gain from May to August on that 225 pounds. Well, if we get some rain and we have some grass, backgrounding not going to just make you a whole lot of money, but it will make you some. It's not going to, it's not like $15, $20, $30 a head or $40 a head is going to be extremely profitable. But in times of low prices, when we've got really thin margins, that may mean the difference between a profit and a loss. And then we go on in and carry them from, let's say we throw them in the feedlot, we're looking at a 72 cents value gain. In reality, I think we've undervalued cattle in those future months, so I think those value of gains will be higher than that when we get to those time periods. All right, I really think those value of gains will probably end up in the upper 80s or low 90s, which reduces some of that risk and says it may be more feasible to play in this game. So with that, I'm going to stop sharing the screen.